Financially raw, real, authentic wisdom with Lawrence Oberholzer from Retire Rich and Happy.
In studio today, we've got our resident tax expert, Gideon Groenewald. Gideon, welcome back.
Good morning, Lawrence. Yeah, thank you for having me back.
Yes.
Good morning to everybody listening.
Thanks for being here. Today we're going to talk everything tax. We're going to be talking about basic things around tax. We're going to give some ideas, some tips, some tricks. How can we make people pay less tax? How can we help them manage their taxes better? So for everybody listening, you're welcome to follow us on Facebook, Retire Rich and Happy. Follow us on YouTube or subscribe to our channel on YouTube. All these shows are put on YouTube, so you can go re-listen to them. That is I Retire. You can follow us there, or you can go to our webpage, retirehappy.co.za. I already got one question. So from Wazda Rockstar, I think I know who this is, Warren. So let me quickly read the question, and then Gideon will answer for us. It says, "Hi Lawrence, starting a new job on the 1st of August and wanted to ask in respect of my medical aid. They have no group scheme. I use the word benefit loosely as it used to come out of my CTC, cost to company anyway. I can transfer my medical aid into my own personal capacity, or I can transfer it to Regan's, which is his wife's, group benefit through AON. The price is the same. However, I wanted to know if it's beneficial from a tax perspective to have the medical aid as a group benefit, or is it better in my personal capacity, or is it much of a muchness because of the medical aid credit system?" So if you can give me an answer, or give Warren an answer, and then Corneille Olivier says, "Hello Gideon." If you want to say hi to Corneille.
Morning, Corneille. Glad you're listening.
Hi Corneille. Ja, gooi die vraag as jy vra het. Okay, so how would you answer Warren on that one? Is it beneficial to rather have it on his own or to move it on to his wife's?
So Warren, that depends. So when it comes to the tax credit, that remains the same regardless of the structure of it, whether a company contributes or whether you pay it fully out of your own pocket. The tax implication comes in if the company contributes towards it, then it's a fringe benefit, which is 100% taxable. So from that perspective, there will be a tax implication, but obviously there's an income portion to it as well. So that's something you need to decide. From tax perspective, there's no benefit on the medical aid tax credit side, but there will be an additional tax on the fringe benefit.
Because it's a fringe benefit. And how does the fringe benefit tax differ from the tax credit? Because tell me if I'm understanding this correctly. So if the company pays a portion, you get that as a benefit, which means that portion is taxed on fringe benefit tax. But then you can't claim that on your tax credit, or am I not understanding it correctly?
Yeah, so how the tax credit works, after you've calculated your tax, you get a credit that you can deduct against your tax liability. The fringe benefit is included in your taxable income. So that's before the tax rates is applied. So that fringe benefit depends on the size of where you are. The tax scales can push you over to the next tax bracket. But that's included in income, and there are very few benefits or allowances where deductions can be made. Currently, it's only a travel allowance.
Okay.
Any other allowance or benefit that is provided is fully taxed.
So it's almost like just having that as an extra income. It's not really as if it's taxed at a different way than just. So let's say, for example, they give him a fringe benefit of 5,000 Rand for his medical aid, or he just earns the 5,000 Rand, the tax on it is going to be equal because it's on this side or that side. It's going to be exactly the same thing. And at the end, the tax credit will be exactly the same. So actually, it doesn't really make a difference on the whole thing, because whether he gets it as a benefit for medical aid, or he just gets it as an extra income and pays medical aid on his wife's side, it's going to be exactly the same thing. So it is much of a muchness.
Yeah, on his pay slip, they can call it whatever. They can call it your basic salary. They can call it a medical aid contribution. It's treated exactly the same for the purpose.
Okay. So it basically will have a net effect. It doesn't make any difference. The only difference it might have, and you must tell me if I'm right, I'm thinking about this now, is if the husband, for example, in this case, has a much higher tax rate and the wife has a lower tax rate, it might be better to have the tax deduction on his tax instead of on her tax, because he'll get a better return or better tax what do I call it, tax refund, because it will be at a higher rate that he will get the benefit. Am I right?
Not when it comes to medical aid tax credit, because for everybody it's
it's a
equally.
Specific amount.
Yeah. So for the prior tax year it was 319 rand for the first beneficiary per month over a 12-month period. That is regardless of who or what you are. Individuals only, and that is the credit you are allowed.
Yeah. And that is, so the tax already gets calculated. So that tax credit for medical aid, excuse me, that tax credit for medical aid doesn't reduce your taxable income like other deductible expenses will. Am I right?
That's correct.
It only comes out at the end. That's why it doesn't make a difference.
That's correct. It's like your rebate, primary rebate
Yes.
that each and every individual gets.
Okay.
It's deducted from your calculated tax amount. So
Yes.
it won't shift you between tax brackets. So regardless of whose name it is, the benefit will be
exactly the same. Okay. Now that's interesting. So Warren, I hope that answers your question. Warren responded, he says, in my case, it was a full cost to company deduction. So I had no fringe benefit prior. Yeah, but it doesn't really matter whether it is cost to company or it is fringe benefit. The tax on that will be exactly the same. Am I right?
Let's say, for instance, his full cost to company is 30,000 rands and split 25,000 as a basic salary, 5,000
for medical
aid contribution, or whether it's fully 30,000 basic salary.
Same thing.
Tomato. It's the exact same thing.
Okay, so it's going to be basically, I think, a question of whose medical aid is the cheapest. Is it cheaper on your wife's medical aid? Maybe you're on different kinds of medical aids. And then secondly, what's the easiest to administer? Is it better to have the husband and the wife on two medical aids and administer two sets of medical aids, or is it just better to have everybody on one? So, and that's a personal decision I think people must make, because I feel it's more admin intensive to have two medical aids than have one.
Yeah, Warren, from experience, not to be sexist, women are much better at admin, so it's better to have her deal with the tax side of things.
Yeah. All right. I hope that answers your question, Warren. Warren says, thanks, guys. It makes sense. The tax credit for medical aid only applies when you do your return. So, yes, it essentially makes no difference. Yeah, so 100%. Okay, so let's have a chat about capital gains tax. This is an interesting one. So I think begin by just sharing with the listeners, again, I know we touched on it last time, but we didn't have time to get into it really. So share with the listeners, again, just quickly, what is capital gains tax? What's the reasoning behind it? Why does the government want a portion of your capital gains?
Oh, so that they can make money. No, capital gains tax is a tax on capital items. A capital item is usually employed to make taxable income. That can be property, it can be motor vehicles, it can be furniture. It's anything that you're going to use for a long period of time to make taxable income with. So that item itself might not directly be bring you income, but it's an income generator.
Okay, and then so explain the dynamic on when you will have to start paying capital gains tax and how they actually calculate your capital gains, how it's calculated, the inclusion rate and those kind of things, because I think most people, or a lot of people, think that if they buy a house, a second property, a townhouse or whatever, for 500,000 Rand, and then 3 years later they sell it for 700,000 Rand, they're going to pay tax on 200,000 Rand. And that's not quite how it works. So if you can explain a little bit about that, how that calculation gets done.
Okay, so capital gains tax, it's not a separate tax. It falls within the umbrella of income tax. You only disclose it to SARS once a year when you do your income tax return. So every time that you buy and sell a capital good, you don't have to disclose it to SARS. When it comes to property, you have to give your income tax reference number. That's so that SARS can keep record of it. Specifically, when it comes to property, it's distinguished between a primary residence and a non-primary resident. And each individual in South Africa is only allowed to have one primary residence. So that is your basic residence, where you stay. It's
yes.
where you sleep and live. and everybody is only allowed one. So there's a little bit more space to move when it comes to primary residence. You get a 2 million rebate when you sell it. So if you sell it for under 2 million, it's not even something to think about.
Okay. So not 2 million profit or capital gain, 2 million value. Done.
Yeah, 2 million value, you don't have to have sleepless nights over it. If you do sell it for over 2 million, it doesn't mean you're going to pay capital gains tax on it. It's just then you need to start thinking about this.
Okay.
Okay, that falls away when you, let's say, for instance, you buy a property for investment purposes or for a holiday home. Then that primary rebate falls away.
Okay.
So there's three terms that needs to be considered when it comes to capital gains tax. It's your proceed. That's the amount that you receive for it.
Okay.
Your base cost, for all intents and purposes, is to simplify it, it's the cost that you paid for that item.
Yes.
And then it's your capital gain. Okay, so you take your proceed, the amount that you've received for it, less your base cost, which is your cost price, then you get your capital gain.
Okay.
Then you deduct your annual exclusions. For primary residence, it's 2 million, and for all other capital items, it's 40,000 per year.
Okay.
So I've got an example here.
Does that, sorry I'm interrupting, but does that accumulate? Or I don't think it does. The 40,000. So if I don't use the 40,000 for a capital gain this year, I can't use 80 next year.
No,
okay.
no.
Just checking. I tried. Just checking. Okay.
It's 40,000 per year. And also when it comes to primary residence, if you are married in community of property and if you and your wife does not each get 2 million, it's 1 million per primary residence. So that's split into two.
Okay.
Each get 1 million rebate on that or exclusion on that. So let's say, for instance, you have a capital item, you sell it for 200,000 and it costed you 100,000 rands.
Yes.
Your capital gain on that will be 100,000 rands. Then
Okay.
you apply your annual exclusion. Let's assume this is not a primary resident. Then you get a 40,000 rands annual exclusion, which means your taxable capital gains is 60,000. Then there's an inclusion rate,
Okay.
which means only 40% of your of your capital gain is taxable. In this example we just had, it's 24,000 rand, which will be included in your taxable income.
Okay. So, and that just gets added to the top of all the other income you have. If you're earning 400,000 Rand from your job, you'll just add that 24 and then it will be at whatever your rate of tax is that you will pay tax on that.
That's correct. And your capital gains is aggregate. It means that SARS takes all of your capital gains that you made during the year, add it together, apply the one exclusion. You don't get exclusion per capital item. You only get one annual exclusion. And it's possible that you can make a capital loss. In the event of a capital loss, you cannot offset it against other income or taxable income. You can only roll it over to the next year to offset it against future capital gains.
And how long can you roll that into the future, that capital loss?
Until you make a profit.
Until you make a profit. Okay, so if you make a capital loss on an item, you can indefinitely keep that loss as an asset going forward, a tax asset going forward.
Yeah, you cannot unfortunately deduct it against
normal income. Okay, so this is an interesting one. So I'm going to throw it to you. Rian says, "Good show, guys." Thanks, Rian. I have a problem. I haven't sent in my tax returns for a few years now, but want to make things right. What do I do now? And are they going to lock me up or fine me with a big fine? Rian, can you just send us your address and telephone number so that we can inform SARS? No, I'm joking. Okay, so let's ask Gideon how concerned you need to be. Should you need to lock your gates, lock your house, and not answer the phone for the next 6 months?
Yeah, Rian, I think our correctional services are a bit overwhelmed at the moment. So I think for now you're a bit safe. I can't speak for future periods. SARS is not in the business of trying to lock people up. They do want people to be tax compliant. So What SARS will do if you're non-compliant, they will issue non-compliance penalties. And as soon as you get up to date, you can ask SARS to remit against those penalties and interest. And usually they write it back. I've never come across where they didn't write it back. Because your intention is not to evade tax. You do want to be compliant, and SARS recognize that in individuals. And they'll give you a pat on the back, say, well done, okay, there's a credit on your non-compliant penalties. So it's never too late to submit, even if you're hiding away when you hear the name SARS.
Okay, yeah, and I also think that there's a big misconception with people that they must be so deathly afraid of the people at SARS. It's not as bad as people make it out to be. They're not out there to get you. You can do things and even make mistakes, and they're not just going to lock you up.
Yeah, what I always tell people is people are very, very scared of SARS. It costs money to audit people. So SARS is not going to chase people for 10,000 rands. They're not even going to chase people for 20,000 rands. There's an illicit market in South Africa. One that comes to mind is the illicit tobacco industry. That's millions and millions of rands for SARS. So they're going to spend resources on that. They spend resources on VAT because a lot of people and companies use the VAT system to try and evade tax. For individuals, SARS is much more lenient, and the Tax Act is created in such a way as to give the individuals a lot of leniency. So as an individual, you get rebates, you get exclusions, you get which companies doesn't get. So the SARS is not out to get you. They do, however, want to collect what's due to them.
Okay, yeah. So just treat them fairly and they'll treat you fairly. And very importantly, again, don't try and evade tax, but you are legally allowed to reduce your tax burden as much as you can within the rules that they give. So don't be afraid to try and find ways to reduce your tax burden, but don't evade tax. Don't not tell them and not pay tax.
You can legally avoid tax.
Avoid, but not evade.
Not evade.
That's it. Okay, I've got another question. It says, guys, can we speak about the effects of claiming a home office allowance on capital gains? I was actually thinking about that while you were talking before the break. In my case, I married ANC, antenuptial contract, with accrual. However, our primary residence is exclusively in my wife's name. I have a dedicated room that serves solely as an office. How would it affect my wife if she claimed for a home office, if we shared an office? Would we both be able to claim the same portion that the office constitutes as a percentage of our home? That's an interesting one. So hopefully you have an answer for us, because I don't have a straightforward answer for that one.
Yeah, so there's various concepts in that. So
in that question, in
that question. So when it comes to home office expenses, SARS says it must be exclusive use space for a specific individual. A shared space does not constitute a home office. SARS will not allow two individuals to deduct the very same expense.
Could they then just split the two? Could they say 50% of that home office is for the one and 50% for the other one?
They can, but they need to be able to justify that to SARS, to say, okay, listen, in this year this is how we done the calculation on this, and we are doing it in future tax periods as well. You need to prove to SARS that your intention is not to duplicate expenses, to defraud SARS. You are doing a justifiable calculation on the office space, and then you're splitting it between the two of you.
So as long as you can justify it, you'll be able to at least have half.
Yeah.
Again, I think this is specifically a situation where you can look at who is the highest taxable income and maybe decide to take that deduction on that person instead of the other person.
Yeah.
Am I right?
Yeah. The another part that also needs to be considered when claiming for home office expenses is the capital gains tax implication.
That's what I want to get to, yeah.
The moment you use a portion of your house for business purposes, that falls away from primary residence. So you do not get the full 2 million exclusion on that portion of the house. Then a proportionate calculation needs to be done, and that portion that was used for business purposes will then be excluded as a primary residence.
Okay, so you won't lose the whole exclusion for it being your primary residence, but you will lose a percentage of that or a portion of that because a portion of your house is being used for business. Am I understanding?
That's correct. And remember, when you purchase the house, SARS asked for an income tax reference number. So SARS knows if you own properties. And SARS can also check on that individual's income tax returns. Did they claim home office expenses
on that property?
Exactly. And the day you sell it and you don't declare the capital gains tax on it, so they're going to say, wait a minute, we allowed you a deduction for business purposes on a private use residential property. Where's our capital gains portion on that?
Okay. So let's say, for example, and I've seen this quite a bit, where people have their house and they start moving into retirement times and they build on a granny flat or another flat and they rent that out. So that's now generating income for them. How does that affect their primary residence capital gains tax calculations?
Sure, that's an interesting question. Give me a moment to think about that.
Would that the question is, would that constitute a business? Because some of the expenses on that will be tax deductible. I mean, obviously, if you have a tenant and you're generating income from there, you can claim back some of the expenses on that.
Yeah, I would assume that portion of the building, if there's a secondary building built on the same premises, then it needs to be split proportionately because there's an income generating portion of it. So it's not private in nature anymore. Even though the people's occupying it is using it for private purposes, in the individual renting it out, it becomes a business portion thereof.
Yes. So I would assume it's similar to what you're saying with a home office, where if you have a deduction on the house, so basically, and you can maybe confirm it in our next show, because you're definitely coming back. But in our next show, we can actually just confirm that. But I would think that they would look at that same expenses and saying, well, you've got 30% or 10% of your properties, you claiming expenses for that, so we're going to take 10% or whatever the case may be on the abatement or that primary residence abatement. Okay, so go find out if you can give us some feedback on that. Another question, follow-up question: would the home office claim then be allowed for a taxpayer who is renting? Because then there would be no capital gain item or asset. Let me just try and look at that question again. Would the home office claim then be allowed for a taxpayer who is renting? Okay. Because
Definitely.
then there would be no capital gain tax. Okay, yeah. So if you are renting a house and you use a room for a home office, you can claim it against the rent that you're paying, but there's no capital gain because the capital gain is only on the selling of that property.
Yeah, I almost think that if you do rent a property and conduct business from that property, you've got a greater benefit than the individual that owns a property, because the full rental amount can be deductive if that full property is being used for business purposes. While as an individual, they can deduct only the interest that they pay on their bond. So it's only a portion of their monthly installation that can be deducted. So when you rent, there's a bigger benefit to it for tax deduction when it comes to home office expenditure.
Just an interesting question while we're at that. If you now own your property, you have a home office that is 20% of your total property. Could you claim back a portion of your rates and taxes as well? Or is rates and taxes not part of that?
No, anything. If you take that expense away, will you be able to conduct business? If you take rates and taxes away, then you have to make away of that portion of the property. It's impractical. So yes, your rates and taxes, your municipal electricity, so usually your water and electricity is indistinguishable on your bills, so that portion you can claim as well. Your domestic, if you've got a domestic as well, portion of her salary as well, because that home office needs to be cleaned as well. If you've got people over that you give coffee to, don't go crazy and go claim all of your grocery money during the end of the month or a percentage of it. Be realistic. What is being used at your home office for business purposes? Can it be justified? And can you prove it to SARS that it's being used for business purposes? You can't prove to SARS that you are using potatoes or steaks in your home office. You can justify coffee.
Okay. Yeah, so I like that statement you made, and I think that's something that people can really even write down. You said anything that if we take it away, you wouldn't be able to do business anymore. That for me, and that expense then becomes tax deductible. I like the way did I say it correctly?
Yeah. If you take it away, can you still use your home office if you take a portion of your expense that you want to claim away?
Right. Yeah, I like that because it gives us a simple question to ask to know if this is something that I could potentially deduct or not. So if I don't have this, can I still take that away? Can I still generate income? Okay, so let's get back to capital gains tax again. Tell me a little bit about the deferring of capital gains tax. When would I not have to pay capital gains tax the moment I sell an asset?
So when it comes to the deferral, the Tax Act makes referral to rollover of capital gains tax. I've never dealt with this in practice before, but what I've read from it, it's only applicable to depreciable assets.
Okay.
So if you've got office equipment that you can depreciate that over a period, property does not fall under this category unless specific conditions apply, like developing special economic development zones. And I don't think most people, unless you develop a developer, that's applicable. But let's say, for instance, you've got home office expenditure, you go over your annual exclusion, you make a taxable capital gain, but you want to reinvest that money into acquiring the exact same asset.
Yes.
You can roll it over for a period of 12 months, and the commissioner can also extend that for another 6-month period.
Okay. So if you use that, you make the profit, the capital gain, and you're going to put it into another investment, you have 12 months to do that, and then you don't pay the capital gains tax immediately. Am I understanding that correctly?
Yeah, I think the most instances where this will be applicable is, let's say, for instance, there's a total destruction of an asset and you have an insurance claim.
Okay.
The tax act said that that item needs to be replaced within 3 years after the destruction or disposal of that asset. But within 12 months of receiving that income once the proceed is received. So that will generally apply to insurance claims because you don't get the money, you have to submit a claim.
Okay.
So SARS is giving relief to individuals to say, okay, fine, we recognize that there was a destruction of property. You've received your proceed from your insurance claim from it, but we are allowing you to roll it over if you want to acquire the same or similar assets. It doesn't have to be one asset. You can use it for 3-4 assets and then defer that capital gain until you sell it the next time.
Okay. So we're going to talk now about some tax directives. We have a question from Nico on air. I'm sponsoring the premiums of my wife's RA. She's a registered taxpayer. My question is, would she get a refund on the contributions when filing her income tax? Please advise.
Sorry, what's the individual's name?
Nico.
Nico. Good morning, Nico. Yes, if the individual whose name the policy is will be able to claim the deductions. With the medical aid, there's SARS is making, Scott, if you are a member of a medical aid and not the main member but paying for it, you can deduct it in your personal capacity. But when it comes to retirement funding, the individual in whose name it is, regardless of who's making the contributions, will be able to claim that.
Could he, let's say, for example, and I don't know what Nico's situation is, but let's say his wife is a housewife, so she doesn't work. Could he then take the money that he's paying her as a salary that he's paying her and deduct it from his income? Because he's basically using after-tax income to pay an RA for her that she's going to get benefit from. I'm just thinking if she doesn't earn an income, or even if she does earn an income, but they have like a home-based business like we talked about, can he put that in as an income that he's paying her and claim it from his?
Yeah, so Corney that's listening in will know the answer to this question as well. If he is conducting a trade,
yes,
there needs to be an income from a trade. So after tax salary is not a trade.
Yes,
there needs to be conduction of a trade, and he can pay employees, whether that be his wife, to conduct administrative expenses, and he can deduct that full payment to her as a business expense.
So if he has that prerequisite, he can actually almost get double benefit from that in the household, because he'll be able to claim it from his tax and she'll be able to claim the RA contribution benefit as well.
Yes, but remember, when it comes to RA, you've said it in one of your shows before, a tax is unavoidable. The day that you retire, you will
pay
be
it in
taxed
any case.
on it.
Yes. So, Nico, I hope that answers your question. And Nico's comments was, thank you, awesome nuggets. Yes, I'm glad you're benefiting. Yeah, it's these small things that we don't always think about. And the time goes by so quickly. There's so much to talk about. And when you start getting into these small, intricate details of how things can work. So let's quickly chat a little bit about tax directives. First explain, and we're going to talk here about individual tax directives. People who earn a commission or they're self-employed, etc., etc. How does those tax directives work? And when do people use them?
Okay, so a tax directive is instruction from SARS for an individual that you can give to an employer, or if you are an independent contractor or a personal service provider, that you give to the company that you're employed by, to say, this is the instruction just saying that this tax rate is applicable. So regardless of whether your income falls within that tax bracket, they need to apply this tax directive. It states that the employer cannot deviate from this.
Yes.
A tax directive is applied for in advance. You can't apply it historically. So you can only apply it from the day it was issued for the next 12 months. You have to renew that application every year.
Yeah. Okay.
This tax directive you apply for does not override Income Tax Act. So that means even though you're employed, the employer is deducting a specific amount from you consistently, regardless of your income. By the end of the year, when you file your tax return, normal income tax rates will still apply.
Yes.
So some people face the danger, especially commission earners, because it fluctuates a lot. That, let's say, for instance, you apply for a very low percentage tax directive and SARS approves it. Your employer will apply that throughout the tax year. Then come the end of the year, you file your tax return, and then you've under provided in this tax directive, and you're most probably going to pay in.
Yes.
But there is a benefit, because commission earners can claim certain deductions that instead of having to claim back a huge amount at the end of the tax season, you can apply that throughout the tax year to better your cash flows.
Yeah. So basically what happens is, instead of you doing your tax, paying full tax during the year, and then that money sits in a SARS account somewhere, they get all the interest and the benefit from it, and then end of the year you're given all your expenses, your deductions, all of that, and then you get a refund from SARS. With a tax directive, you pay less every month, so that money stays with you, and then at the end of the year you just get a smaller refund.
Yeah, or you'll have to pay in. It depends on how much the directive you've applied for.
Yeah.
This will apply to individuals whose income fluctuate every month. This is just to stabilize your monthly income, because we all have fixed monthly expenditure and we need a certain amount to survive every month. So if your income is jumping from 20,000 to 50,000 to 30,000 to 10,000, you can apply to SARS for a tax directive, give that directive to your employer, and your employer will apply a consistent. It does not mean your tax will not differ on a monthly basis. You will just be taxed on the same tax percentage every month.
So I think the one thing that we need to address, and you can just share that with the listeners as well, is I've seen it so many times that the employers, especially who has reps and salespeople that work on commission, the employers almost make it as a company benefit that you can get a tax directive because you are now a commission earner, and so they sort of sell it as this global benefit to have a tax directive. But people need to understand that tax directive can be a bad thing for you as well if you don't apply for it at the right time, when you're at some place financially where it's worthwhile doing that.
No, definitely, because you don't want a company can apply on behalf of an individual for a tax directive, and you don't want your company to apply for a too low rate. So by the end of the year, if, let's say, for instance, consistently through the financial period, the tax directive was applicable, you were taxed at 31%. By the end of the year, your marginal rate was actually your 36%, sorry. Then you're going to have to pay tax in. So it will not be to your benefit.
Yeah. And then also remember, if you want to apply for a tax benefit, when you work on commission, you pay normal tax. You pay on certain levels. So if you don't pay tax from Rand 1 at that percentage, it differs. Where if you have a tax directive from Rand 1, you're going to pay 18%. So it could be that this month you're only earning 6,000 Rand, so there's no tax payable for this month. If you're on a tax directive, you're still going to pay that 18% or 20% or whatever.
That's correct. And most payroll systems today, they account for your whole for your annual tax. So if month 1 you've got a low income, month 2 you get a higher income, the payroll system will offset against a prior month as well. So regardless of whether your tax rates jump every month, the payroll system will usually average it out for the year. So by the end of the financial period, you don't have to pay in or have to claim back. Yeah. So you break even on that. Yeah.
And you might have some months where you have a good month, or a bad month where you actually get tax back on that monthly basis because you'll have a negative tax for that month. I've seen it with the people that work for us, where I get the payroll and they have negative tax. So I'm basically paying them
There's
extra.
a possibility of a negative tax. There's also a possibility that, let's say this month you only do 10,000, next month you do 50,000, and you'll expect a higher tax next month, and you see, oh, my tax is lower. That is because the payroll software automatically averages out for the year.
Yes. So then I want to jump. I'm going to jump past the deductible expenses for now, because this takes us into this thing about marginal and effective tax rates. People have no idea what their actual tax rate is. They don't know what they're paying. They just hear this, I'm in super tax, so I pay 45%. But it doesn't get to 45%. So I think if you can explain to the listeners the difference between the marginal and the effective rate, and when you look at those effective rates, it's actually much lower tax than people actually think they are paying.
Yeah, look at the income tax brackets as steps. Your first part of your income is taxed at a rate. The next part is taxed at the next rate. The next part is taxed at the next rate. So that means each portion of your income is taxed at a different rate. That is your marginal rate. By the end of the year, end of the day, when you include your tax credits and all of your deductions, and you take your tax liability, your tax payable to SARS, and divide that as a percentage of your income, then you will get to your effective tax rate. And your effective tax rate is 100% of the time much less than your marginal tax rate.
Yeah. I've got the tax tables open here for 2022, and from Rand 1 until Rand 216,200 for the year, you're paying 18%. So 216 is almost 19,000 Rand a month. You're paying 18%. From 216,200 to 337, you're paying a fixed amount plus 26% over 260.
That's correct. And that fixed amount that has to be added to the percentage is the portion at 18%.
Yeah.
And so the brackets goes up
the whole time. So the maximum is 1.6 million and above. You've got 587 plus 45%. So it's not 45% on your income.
No.
Is you've got that fixed amount plus then the 45%. So if you do go figure out your average tax rate, your actual, effective tax rate, before you look at a tax directive, for example. I did a calculation the other day. If you have a tax directive for 20%, for example, you will only have to earn, or you will have to get to over 35,000 Rand a month before your average tax rate will go over 20%. So if you're not earning that, don't get a tax directive for 20%, because otherwise you're going to pay more tax every month than you would have. And that's not the idea behind a tax directive.
Yeah, definitely. And I've also realized individuals are under the impression if they get a bonus, super tax is applicable to a bonus. That is not the case. Usually a bonus is paid out in December, and the tax year only ends in February. So what the payroll software will do, once again, it averages it out. So it will say, okay, December, January, February, that's 3 months. So it will split that portion as if though you received a consistent amount over the next 3 months and apply that tax rate.
Right.
Or what they can also do is they will deduct the full amount from the bonus itself, and that's why in December specifically, when you receive the bonus, your tax might seem high, but the next month it's lower, so it's averaging it back to what it should be for the full year.
Yeah.
So the thing that people think a bonus automatically 45% tax applies to a bonus, that is not the case.
Yeah, it all comes down actually to what are you earning for the year. What you're earning every month isn't actually what they need to calculate your tax liability. It is what you have earned for the year. So that bonus is just part of whatever you've earned for the year. So if they just add it for that 1 month, your 1 month income would go higher, but it's still at the end of the year when you do your tax return, they're going to look at the total income for the year, and it will be at exactly the tax rate as you would have earned in any case, unless it pushes you into a different bracket. Am I right?
Yeah, so for salaried individuals, there's various allowances and various structures to your salary. You can earn a commission, but again, your commission will be taxed 100% by your employer, but you are allowed certain deductions against that commission, so you can claim money back. Allowances as well. Travel allowance is only taxed at an effective rate of inclusion rate of 80%, but you have a travel logbook which you can claim against that and reduce the value of that income portion. It can be as little as zero, so that portion falls away in your annual tax calculation.
Okay.
Financially raw, real, authentic wisdom with Lawrence Oberholzer from Retire Rich and Happy.
Hi guys, Lawrence here. Thanks for watching this video. I hope you found it informative and you got some benefit out of it. Please add in the comments any questions you might have or any other topics that you would like me to talk about. Please subscribe to our channel, hit the bell button so that you can get notified of any new videos that we post so you don't miss anything. Thanks guys. See you around.